Hey everyone, and welcome. Today we're going to pull back the curtain on a term you've probably heard thrown around. One that can sound a little, well, complicated. The family trust. So what is it really? And how does it all work? Let's dive in and break it down. Let's just tackle the elephant in the room right away. When I say family trust, what pops into your head? Is it sprawling mansions, private jets, people with names you only read about in magazines? That's the cliché for sure. But is it the truth? Yeah, let's just go ahead and smash that myth to pieces right now. The reality is, family trusts are not some exclusive club for the 1%. Seriously. You, me, your neighbor, pretty much anyone can set one up. Exactly. This has nothing to do with being a millionaire. It's a financial tool, a structure, and it's a way more accessible than most people realize. So the big question is, what does it actually cost to get one of these things off the ground? And here's the number that really brings it back to earth. This might surprise you. We're not talking about tens of thousands of dollars or anything crazy. Typically, you're looking at a one-time setup cost somewhere in the ballpark of $2,000 to $3,000. See? Suddenly feels a lot more doable, right? So now that we know it's not going to break the bank, let's get to the fun part, the why. Why would you even want one? Well, I like to think of it as unlocking a few financial superpowers for your family. Now, there are a bunch of perks, but they pretty much all fall under these three main powers: protecting your hard-earned assets, being really smart about your tax strategy, and making sure the future is way smoother for your loved ones. Let's look at each one. First up, asset protection. This one is huge. The whole idea is creating separation. Like this quote says, you can control everything in the trust, but on paper, you don't technically own it. And that's the magic trick. You can't be sued for what you don't own. So if life throws a nasty lawsuit your way, the assets inside that trust are generally safe and sound, walled off from your personal problems. And this ties right into estate planning. A trust is kind of like a ship that just keeps on sailing, even after the captain is gone. It doesn't die with you. That means the assets inside it don't get tangled up in your personal will or stuck in probate for ages. The control just gets passed on to the next person you designated. It's an incredibly smooth handover. Okay, so we've covered the why, which is pretty compelling. Now let's get into the nitty-gritty of how. What are the moving parts here? Who are the key players on the team? It's actually really logical once you see it laid out. All right, first, every trust needs a trustee. Think of the trustee as the manager, the administrator, the person steering the ship. They have a serious legal duty to do what's best for the people who benefit from the trust. Now, a person can be a trustee, but often it's recommended to set up a company to act as the trustee. It just adds another, even stronger layer of protection. So, who is the trustee working for? The beneficiaries. And just like the name suggests, these are the people who get the benefit of the trust, usually your family members. They're the whole reason the trust exists in the first place. Now, this is a really critical point to understand. A company is a separate legal entity. It's like its own person. It pays its own tax. A trust, on the other hand, isn't a thing at all. It's a legal relationship between the trustee and the beneficiaries. This is why the trust itself usually doesn't pay any tax. The income simply flows through the trust to the beneficiaries, and they pay tax on their share. So what governs this whole relationship? It's a document called the trust deed. You can think of it as the official rule book or the constitution for your trust. A lawyer prepares it, and it lays out everything. All the rules, who the beneficiaries are, what the trust is allowed to do. It's the foundational document. And bringing one to life is a pretty simple three-step process. First, a lawyer drafts that all-important trust deed. Second, it's signed and witnessed to make it legit. And finally, it gets an official stamp from the Revenue Office. And just like that, boom, your family trust is officially up and running. All right, enough theory. Let's put this knowledge to a real-world test, because this is one of the most common questions that comes up when people start thinking about trusts. So here it is. Should you buy that investment property using your family trust? This is such a big question, and let me tell you, there is no single right answer. It's all about weighing the pros and cons for your specific situation. Let's break this down. On the plus side, a trust gives you fantastic asset protection, and the tax flexibility is a game changer. You can distribute the rental profits to family members in lower tax brackets. So instead of you taking the hit at your high tax rate, you could distribute that income to, say, your university-aged child who earns very little. They'd pay way less tax on it. That's a huge win. But it's not all sunshine.
It can be more of a headache to get a mortgage from the banks. And here's a big one: negative gearing. If the property runs at a loss, those losses are trapped inside the trust. You can't use them to lower your own personal income tax bill, which is a major strategy for many investors. You might also face a higher land tax bill. So you see, it's a real balancing act.
So after all that, we land back at the most important question of all. With all these moving parts and trade-offs, how do you actually decide if this powerful tool is right for you and your family? Ultimately, it really does boil down to this. It's a balance. You have to weigh the short-term setup costs and the added complexity against those really powerful long-term benefits of protection and flexibility. It's a deeply personal decision, and there's no one-size-fits-all answer. And that leaves us with one final thought to ponder. A family trust can be an incredible vehicle for protecting what you build and passing it on to the next generation. The question isn't if it works, but if it's the right choice for your family's financial journey. And on that note, here is the single most important piece of advice in this entire explainer. Please, before you make any decisions, go talk to a professional. Speak with an accountant or a lawyer who specializes in this. Getting that expert advice tailored to you is absolutely crucial. Getting it right from day one will save you a world of headaches and a lot of money down the road. Thanks for tuning in.